From an investment manager point of view, who are they? Have you heard of them? You're entrusting them with your hard-earned money. So you want to make sure the manager's been established for a period of time. Normally, you're looking for a manager who's been around at least 3 years, or a fund that's been around at least 3 years. As I said before, past performance isn't a guide to future performance. But if I'm trying to assess a manager, I want to be able to look at least a 3-year track record, and ideally across different market cycles to see how they performed.
Welcome to the Teaminvest Wealth Builder podcast, where we help you build smarter wealth and make more confident investment decisions. Welcome back to our second part in this 2-part series, focusing on how we recognize a good fund. I am joined once again by Stuart James. I'd recommend, if you didn't listen to part 1, that you jump in and listen to part 1. But if you did, just sit back and relax as we go through how you recognize a good fund. Okay, so let's move on to moats then.
Yes.
When we're talking about having strong moats, which we talk about, what is a strong moat for a fund?
Yes, so again, it's a little bit similar to when you look at a company. What does the fund do that's different? What are they doing which gives them a better chance of success?
Yeah.
So when I think about moats on a fund, I'm looking at things like what's their overall strategy and how is that differentiated? What's their edge that perhaps another manager isn't easily able to replicate?
Okay.
Now, one thing I would say here is, having been in the industry for a number of years, a lot of fund managers often make very similar claims. So if you go on a fund manager website, a lot of them will talk about being long-term. But I can't think of any managers who kind of claim to be short-term. But it really is, do they do what they say on the tin? So all these things are worth taking a closer look at. So if I'm investing and I'm looking to invest for 3 or 4 years, I want that fund to be aligned with that. You know, if I'm looking to make a return over 3 years, then I don't want to be investing in a fund which is looking to make a return over 7 years, because I'm likely to be disappointed potentially.
Yeah.
Or a fund which is actually looking to make, short-term returns. So it's important that's aligned with your own objectives. So you can have a look at the fund. Don't forget, you can always ring the manager as well and ask them questions. Not everything's always readily available on the website, but you can normally see the top 10 holdings in a fund. I would be looking to see how often they change. Are they adding value because they're long-term investors, or are they trying to add value because they're effectively traders and they're buying and selling out of stocks in a relatively short period of time?
Right.
So long-term for me is generally 3+ years, 3 to 5 years. And yeah, I really want to see my manager's process aligned to that time horizon.
Okay. And when we're talking about, we often see the term conviction.
Yes.
Or high conviction.
Yeah.
What does that mean?
So again, if I'm wanting a market return, go passive. There's nothing wrong with passive investing, but you are going to get a market return. If I'm putting my money into a fund which I'm hoping is going to generate me an active return or a return above the benchmark, then I want to see, has the manager got conviction in their own ability to pick winning opportunities? So if I look at a portfolio with, say, 100 stocks in it, well, this won't be the case, but on average, you're going to have about 1% in each position. Now, even if that position or that company doubles, it's not really going to have any meaningful impact on performance. If it goes from 1% to 2%, it's not really going to drive performance. Yeah. So you want diversification, but diversification isn't simply just owning lots and lots of companies. So I generally would like to see a manager who's backing themselves, has a high conviction, is putting more of your money in their best ideas, not simply just spreading it like Marmite on toast. Can't use Marmite, can I? That's a UK phrase.
That's okay. We all know what Marmite is.
Vegemite, as my kids would have on their toast, or marmalade in my case. But yeah, you want to see a manager who's backing themselves, has conviction. You can look at the top 10. You'd often expect to see some of the bigger positions being, 8-9% of the portfolio. And it's a real indication that they're actually backing their best decisions. The reality is your 100th idea is not your best idea. So why put your client's money in your 100th best ideas? So the best way to build a high conviction, concentrated portfolio, which hopefully beats the market over time, is to put most of your money to work in your best ideas.
Okay, so it's really, if we're thinking about moats, we're looking for those things that do set sets them apart? Why will they potentially give us better results
Yes.
than others?
Yes.
Yeah.
Yeah.
Sorry.
And checking that they're true to that label. So, as I say, a lot of managers will throw out the phrase long term, but are they really long term? A lot of managers will say they're high conviction, but then you find out when you look at the portfolio, there's 80 stocks in there. I'd argue that's not high conviction. So it is partly about finding those managers who actually do deliver on their promise.
So when we're looking at long term, we're also looking at how often are they trading?
Yeah.
Are they, as much as they may say that they're long term, but if they're doing a lot of trading, they're not really staying in any particular company long term.
No.
And then also if we have a look at the high conviction piece, if they're spread thin across a lot of companies, then really are they following that sense of conviction about a particular company that they want to back?
Yeah, absolutely. So one way of measuring this is something called active shares. So how different is the portfolio to the benchmark? As I say, there's nothing wrong with passive investing, but if you're paying an active fee, I want active management. And some managers, unfortunately, are what I call closet benchmark huggers. So what they actually effectively do is they build a portfolio which is very similar to the benchmark. And I've been in the industry for many years. I should probably choose my words carefully, but I would suggest in some cases that's more about the manager managing their risk, i.e. their fear of underperforming. If you copy the benchmark quite closely, you can't significantly underperform. However, as an investor, conversely, you're not likely to significantly outperform either. And by the time you take off an active management fee, which could be 1%, then actually you're probably quite likely to get a benchmark return or a market return. And that's why there is some skepticism around managed funds. A lot of managed funds often underperform. I would argue it's because they're not really high conviction. They're not taking a long-term approach. So these are things you should be looking at to make sure that if you're paying an active fee, you're getting active management. And by active, I mean being different, actively different, making the decision to be different to the benchmark, not active in terms of
buying
trading.
and selling all the time.
In fact, if anything, you want to avoid that. One, because it means they're short-term, they're not taking a long-term approach, but there are costs associated with that as well. Every time a fund manager trades, that's going to cost you money. And of course, it can also lead to tax events as well. So patience is often undervalued in investing. Finding a great opportunity, investing in it, being patient, holding that company for a long time generally will deliver you better returns. We know that as stock investors. We want to see our fund managers also taking a similar approach.
That makes sense. And I guess once you've uncovered all of this and you've found someone that is long-term, if that's what you're looking for, that is high conviction, if that's what you're looking for, then I'm guessing you want to know that they're going to stay, but you're going to, the same people that are making these decisions are going to be there long-term as well.
Absolutely. So as a general rule, try and avoid funds which have a lot of key person risk. If there's one star fund manager, and perhaps he's spending a lot of time doing press and is making a name for themselves, maybe versus spending time actually managing the portfolios, that can be a bit of a warning sign. If you're a bottom-up stock picker, which we touched on before, are you spending all your time researching companies? Then you need resources to do that. So, is that a competitive edge for this particular fund manager? Do they have lots of resources? And are they able to cover a wide waterfront of businesses? Very hard for a couple of analysts to cover 100 companies. So you need to make sure the team's, is appropriately sized. And if you're talking about global equities, then of course, you're talking about tens of thousands of companies potentially that you could be looking at. So I'd be looking to see, one, who is the fund manager? Who is the named portfolio manager? How long have they been with the business? What's their background? Where were they previously? I'd be looking at the size of the team and the amount of resources available. And this isn't critical, but as a general rule, if I'm investing globally, I'd probably want to see some of those resources placed globally, particularly if the manager is doing company research. So not all managers do. Some managers won't go and visit companies, but if you're a manager who's claiming that you go out and you visit companies, you travel, you go and sit down with the board members, you sit down with the CEO, then having people on the ground or located around the world in regions where they're able to go and do that on a regular basis, they themselves work and live in that particular market, so they can see from their own life experiences which businesses are doing well, how's the economy going, and I think that does give them further insight. So not critical. But if they're making claims around understanding businesses, visiting management teams, Do they have the resources to do that? How frequently do they travel? And how well do they know the markets that they're actually investing in?
Yeah, because it's that actual, are they set up practically to do what they're claiming to do?
Absolutely.
And I know that when I've spoken to Andrew Coleman previously, we've talked about how many different assets or how many different shares should you actually have in your portfolio. And we've discussed, well, how much time can you actually spend researching and getting to know these companies if you have a huge number in?
Yeah, you're spot on. And I think that goes back to the point we were talking about before about having a concentrated portfolio. It's a lot easier to know 50 companies very well than it is to know 200 companies. So yeah, you need to stick as a manager to your circle of confidence. You need to make sure you have the right resources to cover those companies. Not only do you want to go and visit them before you invest, but managers who do that will also want to go back and visit them on a regular basis. So I'm not suggesting here that you have to go and see management, to be clear. There are lots of different ways you can invest, and some people would argue sitting down with a CEO in their office doesn't necessarily give you a lot of insight. But if you're claiming to do that, then it's important that you're resourced and you're actually leveraging that moat or that advantage that you have. So that's why it's important.
So another thing that we often see on websites when we're looking at funds is the size of the fund. How important is the size of the fund?
Not hugely, other than at the two extremes, I would argue. So if a fund is very small, there is a risk that it's maybe not making money from a commercial perspective for the fund manager. So they committed to that strategy. You don't want to be going into a fund which might get closed. So you want the fund to have some scale. Also, it's encouraging to me if the fund's growing, that other investors are backing this, and the fund's, it's a good sign that perhaps the investors are loyal and new investors are joining the fund. You don't want something which is too small. That's one area I'd look at. Equally, at the other side, you don't want it too big. And what do I mean by that? Well, if you're investing in global equities, too big isn't really too much of an issue. I'd say the average global equity fund could probably invest somewhere around about 1.4 billion before it would be deemed to be too big, as it were. And that's certainly not a risk for me. But if you're investing in some like Australian small caps, the good funds, which attract a lot of inflows and perform really well, they will actually get to a point where they become too big. And what do I mean by that? Well, if you're a big fund, it's going to be very hard for you to invest. If you're investing in small companies and you've got, say, for argument's sake, $2 billion to invest, very hard for you to deploy any meaningful amount of money into the companies within the portfolio. So often small cap companies or small cap funds might cap out, say, around about $1 billion to around about $1 billion.
Right.
And at that point, you probably can't invest any more money into that strategy. That's similar for things like global emerging markets. There will be a point where it actually gets very hard to deploy your client's capital. And then you have to start making compromises. If you can't put any more money into that company, or you can't put any more money into your top 30 companies, now you're buying the 31st. And then again, like we were talking before, was the 31st really the best idea? Let's be honest, you rather would have put money probably in one of your top 10. Yeah. But you're now holding 10% of the available shares in that company, and you can't buy any more.
So you're almost forced into decisions rather than being able to make them on conviction.
Absolutely. If you have too much money, it can be very hard to deploy that capital, and you start having to look for where can I deploy it rather than necessarily thinking where's the best place to deploy it. Yeah.
That makes sense. Okay, so is there anything else while we're sitting in Moats? Is there anything else that you would look at to assess as a moat perspective?
I think really it is the things we've talked about. It's making sure that they're true to label, that they have an investment style, that they've been consistent with that as well. You do want the manager to be consistent over time, not changing styles. You want the investment team itself to be relatively stable. That's a positive sign. Yeah. There is no, unfortunately, surefire way to make money. So there's not a silver bullet here whereby you can say if a fund manager does this, they're guaranteed to outperform. But consistency of process, a very well-defined process and philosophy, a team of analysts who've been together for a long time, who've consistently applied that process to their market, whose performance track record demonstrates that, is really critical. Those are the kind of things I'd be really focusing on, looking for a manager who has those characteristics.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
Okay, so we've done our S, we've done our M. Now let's move on to R, which is risk. What we might do to go through risk, we might break it up into 3 different categories. So firstly, the investment manager, then we'll have a look at investment style, and then we'll have a look at the product. So let's start with investment manager. What are some of the risks? And we may have covered some of these in our other sections, but what do we need to look for under the risk?
Look, understanding risk is very important. So we might cover some of the ground we've already covered. From an investment manager point of view, who are they? Have you heard of them? You're entrusting them with your hard-earned money. So you want to make sure the manager's been established for a period of time. Normally, you're looking for a manager who's been around at least 3 years, or a fund that's been around at least 3 years. As I said before, past performance isn't a guide to future performance. But if I'm trying to assess a manager, I want to be able to look at least a 3-year track record, and ideally across different market cycles to see how they performed. First of all, I want to know who is the manager, how long they've been around, how well established are they.
And that's what we do for Teaminvest as well. When we're having a look at companies, we want to see the history of the company. We're ideally looking for 10 years. So that's definitely in line.
Exactly the same. I would Google the company. You can go to their own website, you can read when they were established and, how much money they manage overall. Again, if a company or a fund manager's only got a very small amount of money under management, that could be a bit of a warning sign. Now, it could be that they're a very new company and they're doing very well and they're growing very quickly. But if they've been around for a few years and their assets under management are relatively small, I'd be asking myself, well, why? If they're good at what they do, why aren't they growing the business? So I would be having a look at the overall business. And then, as we touched on a few moments ago, the team itself as well. How stable is that investment team? If you go onto most websites, you should be able to see some biographies of the fund managers. So I'd be having a look, whoever the main fund manager is, how many years have they been in the industry? How long have they been with this particular fund manager? Again, have a look at some of the older documents on the website. So perhaps go back and look at a fact sheet from a few months ago. Has there been a change in who's been managing the portfolio? You want to make sure you're giving your money to somebody you can trust. Simple things like making sure, they have an AFSL, making sure that there's a financial services guide on the website. All those could be red flags if, they haven't got full disclosure.
And AFSL? What's an AFSL?
Great question. So an AFSL is Australian Financial Services License. I had to think that. Why we shouldn't do acronyms. So and anybody who's looking after your money needs to be licensed, rightly so. As I say, the good news is this is a very regulated industry.
It is.
And Australia in particular is a very regulated industry, which is fantastic. It should give investors a lot of confidence. Unfortunately, it doesn't mean from time to time things don't go wrong. But if you're investing in a reputable fund manager who's been around for a number of years, is fully licensed, has good disclosure on the website, then it's not a guarantee, but they're the minimum things you should be looking for.
Absolutely. Okay, so that's investment manager. What about investment style? What are the risks around investment style?
Again, it's really about making sure that they're doing what they say they do. So it should do what it says on the tin. So making sure if they're making, say what their investment style is, that they're actually following on that. But also, I don't want to see funds which are necessarily taking a lot of risks. Now, again, that'll be partly dependent on your own risk tolerance. But, if they're doing things like long, short strategies, which is where not only do they buy companies because they think they're going to outperform, but they've also identified companies which they think are actually not going to perform, and perhaps their share price is going to drop, and you can actually short a company. So some strategies will be long short, i.e. they will put money in the companies they think are going to outperform, and they will actually short through options and derivatives companies which they think are going to underperform. Now, the simple thing I'm trying to point out there is the more different moving parts you have, the riskier that strategy may be. And again, you just want to make sure that you understand, what are they doing within the portfolio and how they manage money. Are they using a lot of complicated instruments? I personally wouldn't want to see a fund which is leveraged, which is borrowing money to invest in the market. Yes, in theory, could increase your returns over time, but at the same time, it makes it a lot more risky as well. So is there anything there within the strategy which is complicated? Is there any debt in the strategy which would make me wary? And other smaller things as well, like foreign exchange. If you're investing in global equities, foreign exchange rates will have an impact on your return.
Yeah.
Now, okay, depends who you talk to. Some people say over a 4 or 5 year period, that'll wash itself out to a certain degree. Sometimes the Australian dollar is quite strong, other times it'll be a little bit weaker. And at the end of the day, it doesn't make a huge difference. But you can invest in funds which are hedged. What does that mean? It just means they simply take that out of the equation. So they hedge the foreign exchange exposure back into Australian dollars. So you're not subject to the fluctuations of the exchange rate. So yeah, looking at all those kind of things and trying to understand where are the risks in the portfolio. And again, these should all be disclosed in the PDS or the IM as well.
And if someone's interested about understanding all of those things, then we can probably do that in another podcast.
Yeah.
But really, when it comes down to it, it's like what you said about strategy.
Yeah.
If it's something that looks extra complicated and that you don't really understand, not saying that you have to be able to do it. That's not what we're saying about being able to understand it, but that it doesn't make sense or it's just too hard to understand.
There are some really sophisticated investment products out there, and some of them are very successful.
Yeah.
From a personal perspective, I would like to have a good feel for how a strategy actually works. So if the product disclosure statement is full of the Greek alphabet, and I can't understand exactly what's the edge, what are they actually trying to achieve here, then that would probably mean that I personally wouldn't choose to invest in that. Doesn't mean it's not a great product, to be clear.
Yep.
But as an investor, I want to understand where am I putting my money to work? What can I expect from that particular investment? So if it's particularly complicated and very hard to understand, it might be that simply I'm not capable of understanding it and these are professional people. Or it might mean that actually the strategy isn't very well defined and it's been worded that way because it's not clear and simple to understand and it has been overly complicated. So I personally would want to make sure that I understand what the investment style is and therefore what the associated risks are with that.
Yeah. And I guess it comes down to how much risk you're willing to take on as well.
Absolutely.
So if you're somebody that's happy to put money in the market, that you're happy to take that risk that you will lose value or you will lose capital, then that's okay. We're not saying that you can't do that.
No.
You just need to be aware going in.
Absolutely. And you want transparency around what the manager's doing.
Yeah.
So you want to see what they're investing in. There are certain asset classes which are relatively opaque, and therefore it can often be quite hard to assess what the risks are.
Yeah.
Private credit's a good example. It's very hard to know exactly what is in a private credit portfolio. And that doesn't mean you can't make a lot of money investing in private credit, but the risk you're taking on is significantly higher. And your ability to understand exactly what that portfolio invests in, what the risks may be, is certainly diminished. So you need to take that into account when you're thinking about, well, what return do I expect for taking on that additional risk? And what fees am I willing to pay as well for taking on that additional risk? So risk in itself isn't a bad thing as long as it's well managed, well understood, and you're getting rewarded for taking on that additional risk.
Absolutely.
And I think that's the key to the things you should be looking at.
Absolutely. And we've touched a little bit on products in that as well.
Yes.
But if we move on to product, are there any other risks that you'd like to highlight from a product perspective?
Absolutely. So at the end of the day, you are going to be investing into a product or into a fund. So you need to understand, is there anything specific to that particular fund? And that's around things like how easy is it to get your money out? So most funds price daily, weekly or monthly, which is normally fine for most people's needs if you're a long-term investor. But you should check to make sure how often does this fund price? How often will I get the opportunity to sell down? Or indeed put more money into the fund if it's performing well.
Yeah.
If a fund only allows you to trade every 6 months, that might be fine. But again, You just need to take that into account. That can be a long time. Other funds can be relatively illiquid and actually have no liquidity. So if you're investing in things like, sometimes if you're investing in things like property or infrastructure, private equity, those by nature are relatively illiquid asset classes. If you're investing in property, the fund manager can't go and sell the building tomorrow to give you your money back, which is absolutely fine. But you need to be aware of that when you're going into that particular product, that this might have a minimum holding period, for example, for 5 years. So you need to work out, am I likely to need that capital in the next 5 years? Because if I do, it might actually be quite difficult to bring that capital back. So it's really important that you understand those things when you're investing in the product. And again, that's where you can look at the TMD.
Absolutely. And look, this is a fairly extreme example, but anyone that was invested through the GFC will remember that there were some funds that were frozen for a period of time.
Yes.
And people couldn't get their funds, and most of the funds were distributed, but it took a long time. I think it took a couple of years for some of the funds.
Yeah. And again, it is about understanding your own risk tolerance. I'd agree. Generally, you want to be investing in more liquid assets. The good thing about equities is they are liquid. You might not like the price you're being offered, but in theory, if you need to take your money back, you can sell. Obviously, some asset classes, that's a lot harder to do. And as you say, we saw that in the GFC, where some asset classes, particularly around fixed income, became relatively illiquid, and therefore investors had to wait to get their money back. So yeah, those things are all very important. And the other thing to be wary of there as well is it's very hard, and I'd be nervous about those who try to turn the illiquid into the liquid. That's alchemy. So if it's an illiquid asset class, that's fine. If you go into that with your eyes open, you understand this is an illiquid asset class, then you know what to expect. However, if it's an illiquid asset class, such as unlisted property, but the fund manager or the fund is saying to you, you can get your money back every week, I'd be raising questions as to, well, how are they creating that liquidity? Again, there may be mechanisms to do that, but I think you need to understand that if an asset class is inherently illiquid, then you should expect, particularly during periods of market stress, it is probably going to be illiquid.
Yeah, because it's that old saying when people talk about investing in property, you can't sell the garage.
Yeah, exactly. So
so it's what are they doing to make it liquid?
Yeah. So you need to look at that. So you need to look at actually how often does the fund price, what are the underlying assets, but also within the TMD as well. It'll tell you things like what's the average holding period for this investment. It'll also give you an indication that is this a good investment if you're looking for income? Is it a good investment if you're looking for growth? And all that's quite clearly laid out in the TMD, the target market determination. They actually use a traffic light system. So it is very investor friendly. So you can have a quick look and say, okay, well, I'm investing for growth. Does this fund satisfy that need? Yes, it does. Great. Recommended holding period, 5 to 7 years. Okay, yeah, and I'm looking to make a good long-term investment. It prices daily. I can get my money out whenever I want without any restrictions. So yeah, it really is about understanding any particular product nuances which may limit your access.
Makes sense. Okay, is there anything else that you would cover under risk?
I'm sure there are others, but those are probably the key things I'd be focusing on.
Okay, so we've covered looking at our SMART, we've covered strategy, we've covered moats, and we've covered risk. Now we're on to our final section, T, which stands for trustworthiness.
Yes.
So what are we looking for from a trustworthiness perspective for funds?
Yeah. Again, it's very similar to when you're investing in companies directly. When you think about a company, it's a bunch of assets over which a management team sits. You've got to trust that management team that they're going to manage those assets fairly, accurately, and look after your money ultimately. And we're looking for exactly the same thing when we're investing in funds. So trustworthiness for me is how trustworthy is the manager. And we covered a little bit of this under risk. So, who is the fund manager in terms of the business? I would Google them, if they had any blow-ups with any funds, what is their track record? How long have they been around? So we really want to make sure that the business we're investing with is trustworthy. Again, we touched on the risks about, the length of tenure and experience of the actual individuals managing the money as well. Can we trust them? Have they come from a former fund which perhaps had difficulties? So again, you can do a bit of background checking on the actual portfolio management team to make sure they're trustworthy and have got a good track record. But I think one of the good litmus tests for is a manager trustworthy is the other things we were talking about, which is disclosure. How open are they at the end of the day? I want to be able to go onto the website. I want all of this information to be readily available. I don't want to have to be hunting around in sub-menus to find critical information. That would be a slight red flag to me. How easy is it to read the PDS? Is it written in plain English, or is it full of jargon and terms which I can't understand? So things like that for me are absolutely critical in terms of, disclosure, how well it's written, how open, how transparent, and how accessible that information is. And then I guess the real difference between managers is how far above that do they go? So those are the regulatory requirements. You'd almost expect the manager to have to do those things.
Yeah.
But on a regular basis, do they produce a monthly commentary or fact sheet on the fund? How easy is it for me to keep up to date with what's happening in the portfolio? Do I have to go to the website and find that for myself, or do they send that to me in a monthly newsletter?
Yeah.
How open and easy are they making it for me as the investor to keep track of my investment over time? So that's important. I also think another good hallmark of a good manager is one that probably communicates more during difficult periods. Very easy for a fund manager to point to good performance or talk about the successes. How accessible are they and how willing are they to help you perhaps when markets are very volatile and you might be feeling nervous as an investor?
Yep.
Are they reaching out? Are they explaining to you what's happening in the markets? If the fund's underperforming, why is it underperforming? Are they acknowledging that and owning it? And funds will underperform from time to time.
Yeah.
Sounds a bit strange, but you can underperform for the right reasons. And by that, I mean, if you're following your strategy and your process, but right now markets are behaving irrationally, and therefore you're underperforming in the short term, that might not be a red flag. However, if you say you're a growth manager and growth stocks are shooting the lights out and you're significantly underperforming, then maybe something's gone wrong in the process somewhere. So I always think it's really important, how well a manager communicates, particularly around events in the market or around poor performance, not just when things are going well. So I'd be looking on the website for things like the fact sheets, commentaries. One of the things which I think is great about Teaminvest is we go way beyond that in terms of education. We're sitting here right now doing this podcast. And I know we do, regular podcasts on different topics. So it's not a requirement of the fund manager, but I think those managers who are, generally committed to education, keeping their investors advised of what's happening in the portfolios is a really good sign that they're trustworthy, transparent, and open. So, I'd be looking for all of those things on the website as additional signs to me that this is a manager who is, aligned with me and wants to be a partner and is not just simply trying to collect their fees on an annual basis.
Okay, well, throughout these few segments that we've had, we've covered off on our whole SMART review and how we can use that. So strategy, moats, risk, trustworthiness, and how that can be used to assess how good a fund is. We've talked about what to look for and how to find that information. We've also mentioned that we do have a tool that's available if people want to have a look in our show notes and download that tool to make life easier for them. Well, Stuart, thank you so much for joining me. It's been a really in-depth and thorough conversation, and I'm sure our audience will have got a lot out of it. So we'll look forward to having you back again in the not too distant future.
Fantastic. Thank you.
Thanks, Stuart. The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.